Okay, so now let's talk about the mechanics of the forecasting process. And we'll break this process into 6 steps. But really this is just so to make it easier to talk about. Really, there's only a few steps when we're doing this, but let's talk about them in sort of 6 ways. First thing we do, prepare, analyze historical financials. You guys are ready for this? We've been talking about this a lot. Before forecasting financials, we've got to build the correct set of income statement and balance sheet information from the historical data. And that means go through, look at all the footnotes, identify all the operating information, make sure we've got everything in the income statement and balance sheet that's sitting there on our spreadsheet that we could possibly need when we're trying to do no-plat and invested capital. The better able you are to identify all this stuff right at the start, the easier everything else is going to be afterwards. It's also going to be easier to know what to look for. You'll do this for the first historical year. So if I'm doing it now, I'd look at 2010 and I'd try to do the best possible job I could in 2010, identifying all of the relevant information that I'm going to need in the future. Then I have one column in my spreadsheet built, and that can help me make sure I know what to look for when I'm looking at 2011's data and 2012's data. I'm not missing out on anything. So I prepare, I analyze all this stuff, I build it up. It says the right level of detail, but all that really means here is that, again, this is kind of an art, and you'll have to sort of get a feel for what the right level of detail is for different firms in different industries. Next step is build the revenue forecast. And this is a really small but also a hugely important step, because almost every line item in the income statement will rely directly, the forecast will be directly based on your revenue in the future year. In other words, we're going to forecast things as a function of revenue. And that means that if we make a mistake in predicting future revenue, we are going to have a cascading series of errors throughout all the rest of our forecasted financial statement. So we're going to spend a lot of time thinking about the revenue forecast and developing it. And we'll talk about here 2 ways to do a revenue forecast. One's called the top-down and one's called the bottom-up approach. And what we're trying to do here is just do the best we can. Again, nobody can predict the future, and we're always wrong when we do that. You guys have hopefully already I've ingrained that into you. But that is what we need to be thinking about. How can we do the best job given that we know we're going to do a bad one? Then we forecast the income statement. So we'll talk about how to do that mechanically. Again, you're going to have a big example, an Excel example where I walk you through all the actual doing of a forecast. But we start with the income statement, so we walk our way down. We look at reported taxes and we make sure those reconcile with operating taxes. Then we forecast the balance sheet. So we're going to forecast invested capital, any non-operating assets, all the items on the balance sheet on the liability side, on the equity side. We will then finish our forecasted balance sheet by looking at the statement of retained earnings and making sure the income statement reconciles correctly and flows into the balance sheet. Now, any unbalancing of the balance sheet will be done here, will be rebalanced here using either an excess cash or a newly issued debt account to help rebalance the balance sheet, and we'll talk about that in more detail. And then finally, we'll use all that to calculate return on invested capital and no-plat and free cash flow, and do that for all the forecasted years. Okay, so let's walk our way through these 6 steps and see what they look like. First one, and again, I won't spend a ton of time here. This is something that we've already talked about a lot. It's something that we've already done in some level of detail in lots of different steps. But the first step of the forecasting process comes from historical data. Remember, our best prediction about the future comes from the past. So we're going to pull down all this historical data. What I mean about appropriate level of detail is we need to make sure that we're really looking through the financial statements to make sure we haven't missed something or we haven't included something that isn't appropriate. So for instance, here in the balance sheet, let's look at the current liabilities just section from the consolidated balance sheet for Boeing, right? Airplane company. I wouldn't even want to know what their current liabilities looks like right now. Probably ridiculous. I'm sure Boeing's financial statements are going to be a mess this year based on last year's. But here's the current liabilities. They got accounts payable, accrued liabilities. They have something called advances and billings in excess of related costs. They got deferred income taxes and income taxes payable, like we talked about in the last chapter. short-term debt and current position of long-term debt, and a current portion of long-term debt, sorry. So this is the debt that they're paying off in the current year. Now all of those look pretty standard. In fact, we used accrued liabilities when we did our UPS DCF, and we used it as an operating measure. We assumed it was. And what we have to be careful for is that even sometimes relatively common items like this can be misleading for different companies. So if we are looking at Boeing's balance sheet, we'll see that accrued liabilities has a footnote on it. And if we walk down to the footnote, we see that included in accrued liabilities, which I would normally just assume as operating, we've got a whole mix of operating, non-operating, and even some financing items, right? So we've got accrued compensation and employee benefit costs. That's going to be operating. Environmental costs, it's probably operating, depending on whether those are ongoing and tied to their operations. Product warranties, which is probably operating, depending on how it's booked. Forward loss recognition, which is not operating. This is a non-operating item. This is a tax item. Dividends payable is a financing item. And then included in a footnote about an item that's been consolidated is another section called Other, which is actually a pretty sizable part of this accrued liabilities. It's $4 billion in 2012 and almost $5 billion in 2013. So making up like a third of this item is another collection of smaller bits of accrued liabilities. And so we'd have to go try and see if we had any more information about what makes up this other item. So you can see how difficult this is. Again, for every firm, it's going to be a little different. We just have to be really careful. We've got to read through the financial statements, make sure we're not missing anything up. Step 2, absolutely the most important part of the forecasting process. We need to build our revenue forecast. So this is, again, critical because most of the rest of our forecast will be based on our revenue one. So if we do revenue wrong, we're just going to have a cascading series of errors. Right? So there's 2 ways to think about building your revenue forecast. And basically, we are going to do a top-down revenue forecast if we're outside the firm and we don't have full information. We'll do an inside. If we're inside the firm and we do have full information, we'll do a bottom-up revenue forecast. So top-down starts by estimating the quantity and pricing of the aggregate worldwide market for the firm's products. So I think sort of one of the easier ways to think about this is think about it in the context of the car industry. Let's say we're working with Ford. We want to buy a stake in Ford, so we don't have full information. We're outside the firm investors. We're looking at Ford. What we're trying to say is, how is Ford's revenue going to change from 2020, 2021, 2022, 23, 24, 25? How do we think about those changes? Well, the way we think about it is we try to think about the total aggregate market for cars. Ford operates worldwide. They sell cars in all major continents and all major countries, and so do many other car companies, both local and worldwide companies, right? So there's lots of intense competition in the car market. We want to try and estimate the total worldwide market for cars, and we want to try and do it for every type of car, for every sector of car that Ford competes in. So trucks, SUVs, light SUVs, sedans, sports cars, etc. Everywhere that that Ford has got a car entry, we want to try and estimate demand there. And now, just think about how hard that is, right? If you are a junior analyst, you are going to get tasked with undergoing something like this. And think about what it would take to really estimate the total worldwide demand for cars. Is it 1 car per person? Is it 1 car per family? Is that different in different countries? I mean, obviously it is. In the US, for affluent families, it might be 1 car per driver. In less affluent families, it might be 1 car per family. In less affluent countries, it may be 1 car per, extended family unit, or, per neighborhood, or something like that. Right? And certainly the demand for different cars is going to be different in different places. In Boone, everybody wants 4-wheel drive or all-wheel drive because you got to get up steep roads and possibly in snow. But if you're living in Iowa on the flat prairie, you probably don't need any of that. So we're trying to estimate all of these things, and we're trying to estimate pricing. Once we have a good grasp on that, what we're trying to look for is, what is the market share for Ford in all of these sectors, right? They're going to have a bigger grasp of the market share in trucks and light trucks than they are in sedans or sports cars. but they're a pretty big firm. They're going to have a sizable market share across the whole thing. But we're trying to think about where their competition is, where their competitive advantages are, where they do well, where they don't do well. How might those things change in the future, right? Might Ford capture more of the truck market? Might they try to do a big push and capture more of the sedan market? We're trying to look at all those different kinds of things to start our analysis. And then we say, okay, the car market is $45 billion on annual, and Ford captures 40% of that over the historical data that we have. So then we expect that as the car market grows, Ford's market share stays roughly the same, maybe grows a little bit depending on what they have planned. And so our revenue is going to be the total market value times our percentage market share, and that gives us a revenue forecast.